Join us for our weekly market wrap-up is Mark Wenzel from the Hopkins Group. Morning, Mark.
Good morning, Michael.
Now, Mark, you'd have to be living under a rock not to notice that the big news that's occupied reams and reams of newspapers and the airwaves and online has been the federal government's decision to introduce a 3 million cap on superannuation tax concessions. How's that affecting your clients?
Well, again, obviously, there's only sort of 80-odd thousand people, I think, that it's affected. Maybe that's even a little bit too high. But I mean, it certainly what it does do is rattle confidence in the superannuation sector, and obviously that's not a good thing for the economy. But effectively, you get the $1.7 million tax free in your superannuation fund. That's for each individual, and now they've capped the 15% tax above that. At $3 million, and so therefore it becomes a staggered position for superannuation. And the policy is gaining a lot of headlines, but it's not going to impact that many people at the moment. But what they have done is they've said that they're not going to have it linked to CPI, so you'll get that bracket creep over time for people that reach that sort of $3 million. But the main message to take away is that the government, is increasingly looking for ways to increase taxes where it will not hit their, constituents and their voters. I expect, that the next repackaging of the super resource tax, so when we've had, companies, particularly in the lithium space, where they're making huge amounts of money on the resources in the ground because of the price and the demand for lithium. And I would certainly expect the government to potentially introduce a tax, on those resources. And while these taxes are unpopular, the reality is that Australia's got a huge debt load and state and federal government debts and ongoing deficits, as far as, the forecast period. And with an ageing population, it makes the collection of taxes more difficult because, we've got less workers in employment. So, from my point of view, I would expect new taxes, will be introduced. And if they don't introduce those new taxes, services are going to be cut. Otherwise, there'll be something that breaks in the economy.
Now, banks, the competition for mortgages as customers is still pretty fierce.
Very fierce at the moment, and again, there's a big rolling off of people on fixed mortgages who are going to be, receiving offers in the coming months as their rates roll off. But the Macquarie is becoming a significant player in the mortgage market, and it reported loan growth of 22%, which was significantly more than what was achieved by the Big Four. Macquarie have a terrific strategy and have been involved in the mortgages for some time, but their strategy is to attract quality borrowers, and that means quality borrowers that obviously have a good income but have low loan to value ratios, and so their risks of those loans are a lot less, and that basically means that they can make better offers than what would happen in the Big Four. And if you fit into this category where you've got a good income, low a loan to value ratio, so either the value of your property is increased or you've paid down some of your debt, ring up your bank and ask them for a better rate, ask them for a better deal, because they are wanting to keep these borrowers on their books. And this is the issue, I think, for the Big Four banks. I mean, lending growth over the next 10 years is not going to be anywhere near as strong as it has been over the last 10 years. And with more competition and, nimble players working to attack the big banks and get some of that money that where they can make a decent profit and have lower risk, is going to be a continuing theme for the Big Four banks. And so maybe the point I guess I was making is looking at the composition of the shares listed on the Australian Stock Exchange. The banks make up 25% of the index, so it may be time to increase your exposure to other areas within the financial sector, such as insurance companies and some of those smaller companies attacking the Big Four banks and looking at those opportunities for your returns over the next 10 years.
Now, former darling of the market, PointsBet, not travelling too well.
Nah, not going so well. It was a market darling, and they reported that they've lost $178 million in the half year to the 31st of December. But I thought there was an interesting one. Again, we've talked about these on a number of occasions, but with a market capitalisation of about 400 million, and they've got $387 million cash in the bank. The market is expecting obviously more losses, and that's why the valuation's so low. But there could be some value in the business in that they're sort of talking to the Murdoch-backed Better to sell the Australian business, which is they're forecasting about $250 million value for that, which doesn't leave a lot of value for the US gambling business. And they've spent good money in the US. They had a net win rate over there of about $70 million, and marketing expenses are starting to come down. The PointsBet are guiding the market that they've built a good asset in the US and that it's not being reflected in the share price. Again, the US sports betting market is in its infancy with new states legalizing sports gambling. And, if that similar situation plays out like it did in Australia, the bigger players are going to buy up the smaller players. So whatever market share PointsBet can get, becomes more attractive from a valuation perspective. So the stock used to trade as a high as $16, back during COVID, and it's now trading at about $1.35, and it could represent some value, I guess, for people looking to take advantage of the US sports gaming market.
Now, talking about turnarounds, but in the opposite direction, Qantas had a fairly good result.
Qantas result, was very good, and again we've talked about this before, and they're doing a buyback, taking good revenue and good profits in, with prices, with demand for flights, and obviously also lack of capacity there. So again, these airlines are making really good money right now, but again, considering long term whether those prices are sustainable and whether competition's going to eat away at those profits. But certainly shareholders of Qantas are doing very nicely.
They've had a few turnarounds of recent. It's just a matter of not having been spent the money, so less outlay and concentrating on having the figures look nice by having just the revenue side of things pump it up.
Oh, I think so, revenue, but also, they managed to cut a lot of costs out during COVID. Obviously, the workforce was significantly reduced. I think they've haven't bought all of that capacity back on. Again, they've got a lot of planes that had been dormant, and they started them up pretty early, Qantas, which gave them an advantage over some of their competitors. So it is really that demand and supply at the moment with the airlines that are making the profits significantly large. And again, if you've got an airplane that's got to fly with 80%, or you've got an airline that's flying at 100% capacity, that 20% difference really is just profit that drops to the bottom line. So again, capacity becomes really valuable. So as more competition returns to the market, those the amount of people on the planes will reduce from those higher 90 sort of levels, back to 85%, and that sort of brings the profit back down as well.
Right. All right, Mark, we'll leave it there and we'll chime back in next week to see what's happening on the markets.
Fantastic, Michael. Thanks very much.